At its core, accounting is simply measuring information that we've identified and then communicating it to people who need to make decisions. A lot of times I like to make a sports analogy. Pick your favorite sport, baseball, basketball, football. There's all sorts of information being identified, measured, and communicated. Whether it's simply the score of the game to see which team won, or maybe some detailed statistics about somebody's batting average, or a pitcher's earned run average, or something like that. We see that kind of measurement, identification, and communication in sports, and we're seeing the same thing happen in business. But with business, it's dollars and cents that are being reported, or maybe other metrics that are relevant to the business. So accounting is simply identifying information, measuring it, communicating it to people who need to make decisions. Now, there are two broad categories of accounting, if you will: financial accounting and managerial accounting. Financial accounting focuses on conveying information to people who are outside of the organization, external users who need to make decisions. Maybe users such as a bank that might make a loan to a company, or an investor who's trying to decide whether or not to buy shares in a company. Managerial accounting focuses on internal users and internal decisions. Those are the two broadest categories of accounting. Now, certainly there are other uses of accounting information. For example, the IRS needs information for determining your tax liability and assessing whether or not that's accurate. And we've even seen lately sometimes triple bottom line reporting. So in other words, not just financial reporting, but also companies measuring and assessing their social and environmental impacts. So non-financial measures as well. At the core, though, we're giving people information for decisions. Now, as we think about financial accounting, I like to think about a very fundamental concept. Financial statements are supposed to help people assess future cash flows. Now, of course, they're not a crystal ball, so we can never predict with certainty, right? We can't say for sure how much cash is going to flow in the future, but the financial statements are supposed to give us information to help users assess future cash flows. In particular, how much, when, and how likely are the future cash flows. As you take a look at a balance sheet and an income statement, you will be able to hopefully identify information that will help you assess when cash is going to come into the organization, when cash is going to leave the organization, how much those amounts are, and how likely or unlikely are those cash flows. Now, we talked about users, and I mentioned a couple of external users, investors and creditors. But those aren't the only examples of people or entities that might be using financial accounting information. Sometimes a company's suppliers want to see financial statements to determine whether or not the company can pay for the supplies or the merchandise or whatever it's buying from the suppliers. Sometimes customers want to see an entity's financial statements. Take this as an example. Let's say that you are a road construction contractor and you're going to seek a contract with the state of Michigan to repair a stretch of highway. The state of Michigan probably wants to see your financial statements to understand your health, the health of the entity, to determine that you are going to be healthy enough with likelihood to be able to complete that construction project. So these are some examples of the external users who might be using financial accounting information. Managerial accounting, as a reminder, is more inwardly focused. It's used to develop information for managers to make decisions internal to the organization. Managerial accounting helps give information about planning, controlling, and then making decisions within the organization. We're going to spend a lot of time looking at various aspects of managerial accounting, from budgeting to cost, volume, profit analysis, where we will look at the impact of certain choices. So when we get to managerial accounting, just understand that it's planning, controlling, and decision making for internal users. As we look at some of the fundamental differences between financial and managerial accounting, I can think of 7 main differences. First and foremost, the users. As you know, with financial accounting, external users, whereas managerial accounting is primarily internal users. Now, that doesn't mean that these are mutually exclusive. Certainly, managers might use some financial accounting information, and there are times in financial accounting where we lean on managerial accounting information, but the primary foci are external for financial, internal for managerial. Financial accounting is really financial history. Financial statements for external users focus on recording what happened in the past. Now, of course, I just told you that financial statements should help users assess future cash flows, and that's true. They make those assessments using information about what happened in the past. So financial accounting looks at the past, whereas managerial accounting, remember, we're looking at planning, controlling, decision making. Those are things that affect the future of the organization. And these are not mutually exclusive. Certainly, sometimes financial accounting can help us, as I said, assess the future. And managerial accounting often uses past information to make decisions about the future, but their primary foci, financial accounting in the past, managerial accounting in the future. Now, these next 2 differences really kind of tie together. Financial accounting focuses on being verifiable, being objective, okay? So, in other words, if we want to determine whether or not this asset on the balance sheet is valued at an accurate historical cost, we can simply look up the invoice or the payment and we can verify that that happened. And certainly you could do something like that with managerial accounting, but remember, managerial accounting being forward-looking is really worried more about getting relevant information to users so they can make those decisions and so they can make those decisions in a timely manner. Financial accounting is more concerned with precision than with the timeliness of the information. Now, don't misconstrue my message here. It doesn't mean that we can wait a year or 2 to produce the year-end financial statements. That's not the case at all. We certainly want to get financial information out in a timely manner, but we also need to balance that with precision. Whereas with managerial accounting, it's not like we're going to have shoddy workmanship or something like that. We're not going to be loosey-goosey with our measurements, but we may sacrifice a little bit of precision in order to get timely information so we can make quick decisions and be nimble as an organization. Because managerial accounting is so focused on forward-thinking decisions that impact the future, sometimes time is of the essence. And so we sacrifice a little bit of precision so that we can get information in people's hands and they can make a decision right away. Financial accounting tends to look at the organization as a whole, whereas managerial accounting, we may disaggregate. And what I mean by that is with managerial accounting, we may break the financial performance of the company and look at it by product line or by geographical area or by certain lines of business, perhaps. Or even get down to the level of an individual product or an employee or something like that, a division of the organization. Financial statements for external users tend to look very broadly at the organization as a whole, whereas managerial accounting, we need to get more granular so we can make good future decisions. Then we have rules. Financial accounting typically follows a financial accounting framework, financial reporting framework, such as generally accepted accounting principles in the United States, called US GAAP. There's also IFRS, International Financial Reporting Standards, for companies that operate outside of the US. And there are actually other frameworks as well. Some companies can report on the modified cash basis or on the income tax basis, but there's usually a framework that we're following for this external reporting. Whereas for managerial accounting, there might be best practices, there might be guidelines, but there's no prescriptive rules. There's not a standard setting body for managerial accounting. And then finally, the requirement. Financial accounting is often mandatory. The reason I say often mandatory is because there may be circumstances where a company does not have to report externally, but most companies have some circumstance that cause them to have to report externally. For example, if you're a publicly traded company, you need to produce external financial statements. If you're not publicly traded, so in other words, if you're a closely held family business, you may not have a requirement by the SEC to produce financial statements, but you may obtain a bank loan and the bank requires you to produce financial statements. So for financial accounting, there's often some kind of an external requirement that's forcing us to do this. Whereas managerial accounting, it's not required, okay? It's a good idea. You can make better decisions if you have quality managerial accounting information, but at the end of the day, it's optional.